Howdy, folks. Welcome to Liberty Call. Today is January 22nd, 2025. Hope you're having a fantastical day out there in the interwebs. It's been kind of a cold and gloomy day here in, I guess we're in kind of central Colorado, but here up along the Front Range. Looks like the sun's sort of starting to peek out, but it has been cold, cold, cold. Yesterday was warmed up. It got up to about 40, but I don't think today we're getting above freezing. So, anyways, all right. Well, markets are hitting record highs as investors cheer strong earnings and pro-business policies from the Trump administration. Netflix is soaring after adding 19 million subscribers thanks to its push into live sports, while Johnson & Johnson beat expectations but saw shares dip over market share concerns. In the UK, a brewing scandal over missold car finance could cost motorists £30 billion, and a major credit union collapse has left thousands scrambling for their money. Meanwhile, hedge funds are making moves. Millennium's former manager is launching a $200 million fund, while Saba Capital hit a roadblock in its UK takeover attempt. Well, let's go ahead and dive in and see what's going on in the world. So let's start with the markets. Oh, and before we get started, hang on. Before we get started, I almost forgot. You got to give me some thumbs up, a like, a share, subscribe, a follow, and slam that notification bell. All right. Dow Jones up 0.3%, 130 points. Closed at 44,156. S&P 500 up 0.61%, 37 points. Closed at 6086. The NASDAQ was up 1.28%, 252 points. Closed at 20,009. The VIX was also up today, 0.27%. It's at 1510. Canada up 0.12. Brazil down 0.31. And Mexico up 1.06. Headed over to Europe, Germany was up 1.03%. The UK flat at 0. France up 0.86. The Netherlands down 0.02. Spain was up 0.16. Italy down 0.57. Switzerland up 0.63. And Portugal down 0.96. Russian exchanges also green again today. MOEX up 1.24. RTSI up 2.94. And the overnight markets, the Nikkei in Japan was up 1.58%. Australia up a third. New Zealand up 0.28. In China, the Shanghai was down 0.89. Shenzhen Component down 0.77. China A50 down 1.48. DJ Shanghai down 0.81. Hang Seng flat at 0. And the Taiwan weighted was up 0.97%. So those are the markets fit to be told for today, folks. Pretty exciting, I know. All right, well, let's hop into the market recap. S&P 500 hits record high as Netflix AI stocks rally. All righty. The S&P 500 reached a record high on Wednesday, driven by strong corporate earnings and a tech sector rally led by Netflix's stellar performance. Netflix had some strong results. Netflix shares soared over 12% after reporting an impressive 19 million new subscribers in Q4 of last year, far exceeding Wall Street's expectations. The surge in subscriptions was attributed to a robust content lineup, including hit series and regionally tailored programming that resonated globally. The stream giant also announced price increases in key markets such as the US, Canada, Portugal, and Argentina to fund its growing content and investments. Analysts anticipate price hikes will fuel revenue growth this year in 2025, while the ad-supported tier is expected to contribute significantly next year in 2026. Artificial intelligence stocks surged after President Trump, alongside SoftBank, OpenAI, and Oracle, announced a $500 billion joint venture called Stargate, like the movie. The partnership aims to develop extensive AI data centers and power generation facilities in Texas over the next 4 years. Initial investments of $100 billion have been committed, with Oracle and NVIDIA seeing strong gains in response. Corporate earnings are impressing. Early reports fueled broader market optimism. Procter & Gamble gained over 2% on strong U.S. demand, exceeding sale estimates. Travelers companies climbed nearly 4% as robust underwriting profits offset catastrophe-related losses. United Airlines initially rose, but later fell 1% despite posting upbeat Q4 results. J&J, however, slid 2.3% due to declining sales of its psoriasis treatment, Stelara, even though it exceeded profit and revenue expectations. Overall, the market remains buoyant, with investors optimistic about corporate earnings and AI-driven growth opportunities. Yeah, I mean, it's good to be optimistic and happy about the new technologies, but again, folks, don't overlook the solid companies that pay nice dividends and have a long track record of doing business. All right, let's hop into some articles. There wasn't a whole lot of data to talk about today, so that's the stuff I really like to cover on my videos. I like to at least cover 3 articles or 3 stories, but wasn't a lot to dig into today. This one is titled "Extremes Become More Extreme Than Revert to the Mean," written by Charles Hugh Smith of twominds.com blog. So let's see what Charles has to say. The U.S. economy is increasingly reliant on extreme financial policies to maintain the illusion of stability, creating a cycle of escalating instability that could eventually lead to systemic collapse. Policies initially introduced as a temporary emergency measures have become permanent fixtures, with central banks and governments employing unprecedented financial interventions to sustain asset bubbles and economic growth. Again, when the music stops, it's going to get painful, folks. I cannot be any more over dramatic about it. I look dramatic right now, but I mean, this is the one thing that really worries me is, what happens to the equity markets when everyone comes to the conclusion that the markets are vastly overvalued. And, anyways. All right. One of the most glaring signs of this unsustainable system is the extreme concentration of stock market gains in a handful of big tech companies. The so-called Magnificent Seven stocks now account for a disproportionate share of the S&P 500's market capitalization, with U.S. equities making up a staggering 67% of the global stock market. This heavy reliance on a small group of companies has created a fragile market structure vulnerable to sudden reversals. Moreover, stock market valuations have reached record high levels relative to GDP, further disconnecting the financial system from the real economy. The ownership of stocks is heavily concentrated in the top 10% of households, exacerbating wealth inequality and leaving the broader population vulnerable to economic shocks. A significant portion of stock wealth is held by retirees, raising concerns about market stability as this demographic begins to draw down assets. The housing market has also been distorted by years of intervention, with the Federal Reserve and government-backed mortgage agencies effectively controlling the mortgage market. Affordability has plummeted, leaving many Americans priced out of home ownership. Historically, market corrections have followed periods of extreme financial exuberance, such as the Nasdaq's 80% drop from 2000 to 2003, despite warnings from market skeptics that the current era of financial fentanyl continues, with policymakers reluctant to scale back interventions as economic instability leaks through the cracks into the system. The risk of major market reversions grows, leaving investors and policymakers facing tough choices. Yeah, I mean, the way I look at it is that we were headed into a downturn at the beginning of 2020. The smoke signals on the horizon were there, back in the fall and summer of 2019. The reverse repo markets were all kaflooey, and it looked like we were headed into some sort of a banking crisis or something like that. Mysteriously, the whole COVID thing happened and gave a perfect excuse to just pour money into the economy. Everybody forgot about all the financial problems because they were worried about a cold. So, I mean, again, I'm not wearing my tinfoil hat today, but it makes me wonder if all of that nonsense was just a reason to cover up or paper over a terrible economy that was going to fall apart during an election year. And, that's my hypothesis. All right. Last up, also from Zero Hedge, it's The Dollar Stupid, written by Michael Leibowitz of realinvestmentadvice.com. All right. The recent rise in U.S. bond yields has been largely driven by negative sentiment rather than fundamental economic factors. According to a recent analysis, 90% of the 1% yield increase can be attributed to investor concerns rather than real economic data. One major factor contributing to this sentiment is the strength of the U.S. dollar, which has shown a strong correlation with rising bond yields in recent months. Historically, the relationship between dollar and bond yields has fluctuated with periods of positive and negative correlations. However, the current environment has seen an unusually strong correlation, leading some to believe that the dollar's trend is a key driver of yields. Despite this, historical data suggests that the relationship is likely temporary and could shift as market sentiment evolves. Several factors contribute to the dollar's strength and its impact on bond yields. The U.S. dollar's role as the global reserve currency means that it is heavily used in international trade and as a safe haven asset. When the dollar strengthens, foreign economies face challenges such as reduced export competitiveness and higher debt servicing costs for dollar-denominated loans. This, in turn, can lead to a reduced economic activity abroad and increased demand for U.S. assets, further reinforcing dollar strength. Additionally, central banks around the world seeking to stabilize their own currencies often sell U.S. Treasury securities, which can put downward pressure on bond yields. Market sentiment and trader perceptions also play a significant role, with many market participants trading based on the assumption of a fixed relationship between the dollar and yields. Ultimately, while the current trend suggests a strong link between rising dollar and higher bond yields, this relationship may break down as economic conditions and market sentiment change. Investors who can anticipate this shift may find opportunities for outsized returns when the sentiment reverses. Yep. My opinion on the dollar strengthening like it has over the last 4 years is simply because, like that article said, the dollar is the reserve currency. It is, kind of the asset of last resort globally when it comes to currencies. And, right now it's not so much that the dollar is doing better than the pound or the yuan or the euro or whatever. It's the fact that those are just doing worse. It makes the dollar look stronger. So, all right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to USA, DSA Financial Group.com. All your financial planning needs can be addressed there. So give me a buzz, shoot me an email. I'll be happy to help. All right. Well, hope everyone has I'm sorry, I hit the button too quick. Hope everyone has a wonderful evening and talk to everyone again next time. Adios.